Charlie in Toledo takes out a mortgage from a local Ohio bank in Akron. The Akron Savings Bank sells that mortgage to a New York bank so that the Akron bank can loan the money again. The New York bank bundles that into a bond along with 1,000 other mortgages from around the country and sells that to an investor. The investor doesn't know much about that mortgage, and so he wants some insurance. The way we get insurance for that is that the structure that sells the mortgage buys a credit default swap from another financial entity, pays, let's say, $1 on 1,000. And in exchange for that $1 on 1,000, that other financial entity guarantees the mortgage. In other words, if it defaults, they'll give you the money, the other $999. The problem with that was that Citigroup was selling its credit default swaps to AIG. Merrill Lynch was selling its credit default swaps to Merrill Lynch, who was selling them to AIG, who was selling them to Citigroup, and so on and so forth. In a lot of ways, they were going around in a circle. The other thing to remember is it's a little bit like homeowners insurance. If a homeowners insurance company is strictly based in South Carolina and only sells policies on the Outer Banks, then when the first hurricane comes along, it gets wiped out. But if an insurance company sells policies in South Carolina, California, Maine, and other places, the bets average out in a given year. There's a disaster in each place, but the premiums in one place pay for the others. We don't even have national insurance companies. Instead, they go into the reinsurance market for the same reason. But the fact of the matter is the weather isn't lousy everywhere at the same time. The credit default swap market was wholly based on the national price index for housing. So as long as it went up, everybody was okay. But if it went down, all the policies failed at the same time. It was impossible for anybody to promise enough capital to back up the entire U.S. mortgage market. The wealth of the U.S. economy going into this catastrophe was about $65 billion. The GDP was only $14.5 trillion. How could we come up with enough mortgage insurance to back up $11 trillion? There was $11 trillion in mortgages. What's more, we didn't just write insurance on those $11 trillion. There's $44 trillion of credit default swaps out there. We've had swaps written on top of swaps, written on top of swaps, which meant people have been betting in all directions, each thinking one would pay off the other, when if the price of housing went down nationally, they'd all have to pay off at the same time.